Hello everyone, it's Paul Tilley. Welcome back. This is AC 1260 and today we're looking at Unit 6, Accounting for Inventory. What we're really talking about here is a particular type of company, okay? You have to think about now who has inventory. Merchandise firms. And what we mean by merchandise firms, as we learned in the last unit, they are organizations that bring product in and resell it again. So simply they're storage areas for the product until the product is resold. So the real crux of it is, how do we value that inventory? That's really what we're looking at here. So from an accounting point of view, we need to figure out how much is worth and be able to add it to our balance sheet at the end of the period in order to make that assertion that it's worth a certain amount of money. And because inventory comes in over a period of time, and because it might have different prices, for example, you might buy it at a price like gasoline, for example. The price of it might be purchased when you buy a bulk load of it for $1 a liter, and then the next time you buy it, it might be $1.50 a liter. So how do you value what's in the storage tank in the ground if you're a company, because different prices. So we're looking at that in this particular unit. So let's take a look at the key learning objectives. First, we're going to identify components and costs, including in merchandise inventory. We're going to calculate the cost of goods sold in merchandise inventory using a specific identification method known as the moving average and the first in, first out perpetual system, FIFO it's called. And we're going to analyze the effects of the costing methods on the financial reporting. So that's going to be the key things we're looking at. We're also going to look at the lower of cost and market, net realizable value, that is, how much can we possibly get for it. Okay, so let's take a look at the very first thing. Assigning costs to merchandise inventory is really a trick for most merchandise firms. And the reason is because, if you overvalue your inventory, people are going to say, well, your company is worth a lot more than it really is. However, if you don't value it correctly, you could risk undermining the assets or devaluing the assets or undervaluing the assets of your company. So a major goal of accounting for inventory is to match relevant costs against revenues. And accounting for merchandise inventory requires several decisions, which include what items to include and their costs, the costing method, specific identification, moving weighted average, or FIFO, what we're going to talk about in here, the merchandise inventory system, perpetual or periodic, which we're going to talk about in here, and the use of net realizable value or other estimates. So what kind of items are in merchandise inventory? Well, merchandise inventory includes all goods owned by the company that are held for sale. In terms of this stuff we're going to sell, there's always the little flies in the ointment. We need to think about, well, what are goods in transit? Then are they inventory? When do they become inventory? What about goods on consignment? Someone gives you something to sell on their behalf. Is that considered as inventory? And if there's goods damaged or obsolete, they could be damaged in transit, they could be damaged in your shop, or they could disappear, or maybe they become obsolete. How do we revalue those? One of the big considerations is the product in inventory or not? And do you own it? Okay, let's look at goods in transit as a classic example of that. You order a bunch of product from your supplier to bring to your store that you're going to resell. The question that you're going to ask is, do I own it, or do I have to wait to get it to own it? Well, normally the shipping label will tell you what's happening there. There's something called free on board, and free on board shipping point means that they'll put it on the truck for you, but you're going to pay for the truck to bring it to you, okay? If it's free on board shipping, you consider it as part of the inventory immediately when it's put on the truck. There's also free on-board destination. Free on-board destination means you pay for it, or the ownership transfers to you when the truck arrives at your door. So the product is being unloaded into your store. Then, at that point, under that scenario, it becomes inventory. So really, it depends on the ownership. So free on-board, the shipping point means that they're going to put it on the truck for you and you own it once it's on the truck, or free onboard destination, which is when the truck arrives and it comes into your shop, then you own it. Another interesting situation is when goods are acquired on consignment. What that means is that, let's say you own the store and I have a product and I say to you, would you sell this on behalf of me, please? So you say, sure. So you take the item that I have and put it on the shelf in your store and you attempt to sell it. Now the thing is, the ownership never transfers. I still own the product. All you're doing is a favor for me in terms of reselling it. And you're going to pay, you're going to collect the money for it once you sell it. You're going to give me some and you're going to take some for yourself. So you kind of rent a space, I'll call it. Under the consignment system, if you're selling goods on consignment, the ownership is retained with the owner, which is not you. And as a result, it's not recorded in your inventory. Sometimes goods get damaged or obsolete. And in this particular case, they're not available for sale, or the value of them is significantly diminished if they are sold, okay? So generally what happens here is if the goods are not fit for resale, they're garbage basically, they are not recorded or they're taken out of inventory. So if you are selling televisions and I work for you and I drop the television and smash it to bits, that has to come out of inventory. Now the other thing is you say, well, maybe I can sell it for parts. You can sell it for parts and you can get $100 for it. Well, if you know that you can only get $100 for it, the value of that piece of inventory needs to be reduced to the amount that you think you can get for it. And that's known as its net realizable value. Another consideration you need to make is, what is the cost of the merchandise inventory? Generally, in order to be able to cost merchandise inventory, we really need to consider, well, what was the purchase price? Then we subtract off any discounts provided by the supplier for that particular purchase, and add on any costs to get that in inventory and ready for sale, including shipping costs, preparation costs, these sorts of things would be added back on. That then would be tallied to give you the cost of the inventory. So before we begin looking at specific inventory methods or managing inventory methods, let's look at two basic types of inventory systems. First is the periodic. Periodic involves going in and counting the inventory probably every year. Could be every month, could be every quarter, but probably every year. So all you're really doing there is throughout the year you're selling stuff, and at the end of the year you go and count. And effectively, the periodic system is exactly no more complicated than that. Counting stuff, and from that you can define how much inventory you have left for the purposes of your accounting and the purposes of your financial statements. So the problem with that is you can't really tell at any moment in time with a periodic system how much inventory you have. So what accountants would prefer, and what is normally used, is something called the perpetual system. And computer technology and the way we have measuring things today makes a perpetual system much more feasible, information rich, and all of the things that business desire in today's world is caught in the perpetual system. So it's the preferred method. So the perpetual inventory system constantly maintains the amount of inventory. It keeps track of it, figures out what comes in, what goes out, these sorts of things. So at any instant in time, you can evaluate how much dollars worth of product you have on your shelves. And because it's a better one, we're going to focus on the perpetual methods in this course. So in order to keep track of your inventory costs, any firm and any business will have to consider how it's going to keep track of its inventory. So management must really decide on what particular method they're going to use. So there's three really common type of methods. And these methods are going to have an impact on what the income statement looks like and the balance sheet looks like based on their use. The first method is the first in, first out method, where we record inventory coming in and we assume that that inventory, when it comes in, it is the first one to go out. And we also have the moving average method. And we also have specific identification, which is really useful if you don't sell a lot of products, but you sell large value products. As the name suggests, the first in, first out method is based on the assumption that items are sold in the order they're acquired. So when a sale occurs, the earliest units purchased are charged to the cost of goods sold. And keep in mind, the purpose of the inventory is to keep track of costs, right? And it only really makes any difference if the costs change. So your first lot of inventory comes in at $1 and your second lot of inventory comes in at $1.50 for those items. Think about price changes. So it becomes important when the prices change. If the prices are consistent, it really doesn't matter. But first in, first out, the earliest units purchased are charged to the cost of goods sold. So we're going to expense those away first, and then as we get into the newer items, we'll expense those away. So the cost of the most recent purchase remain in merchandise inventory. So let's take a little example to explain FIFO a little more thoroughly. We have here an inventory sheet, and what I want you to do is look at the very top row, and it says on the 1st of August, 801, we have a beginning inventory. And the beginning inventory consists of 10 units that were bought at $91 each for a total inventory cost of $910. Okay, so that's the opening inventory. It has 10 units in it, and they cost $91 each for a total of $910. Okay, so now let's assume that 2 days later we buy 15 more items of the exact same thing. The thing is, though, that the cost now is $106 each. So we buy 15 items at $106 each for a total of $1,590. So we'll see those reflected there. So our inventory now has a total of 25 units in it. Now, under the FIFO method, we got to assume now we're going to start selling those, and what we're going to do is sell the original ones first for the purposes of accounting. So let's go do that. So someone comes in on the 14th of August, Someone comes in on the 14th of August and they say, I want to buy 20 units. So we look at our inventory and we say, okay, we got 25 units on the shelf here. And for the purposes of accounting, we know that 10 of those units, the first 10, which we're going to sell first, are valued at $91 each. The second 10 are of the group of 15 that were bought earlier on in August for $106 each. So we're going to sell 10 of them that cost us $91 each, and we're going to sell 10 of them that cost $106 each. So we need to record that accordingly as our cost of goods sold. So we're going to say, okay, the first 10 at $91 each, $910, and the second 10 at $106 each, $1,060, and this will give us our total cost of goods sold. This will leave 5 remaining on the shelf, valued at $106 each, for a total of $530 worth of inventory remaining on the shelf. Yet another method we can use in order to value our inventory is something called the moving weighted average method. And what the moving weighted average method is we look at the total purchases and we say to ourselves, okay, here's all the money we spent buying, so the total cost of good available for sale, and we simply divide it by the total number of units that we purchased to make available for sale. So again, going back to our example where we had 10 on the shelf at the beginning of August at $91 each for a total of $910 worth of inventory. And then we went on the 3rd of August, we bought 15 more, but they cost $106. So we have a total of 25 units on the shelf. Okay. Now, the thing is, some of them were bought for $91. Some of them were bought for $106. So what we can do with the weighted average method in order to get a cost of the inventory is to take the average cost. In other words, 10 were bought at 91 and 15 were bought at 106. So 10 times 91 is 910 plus the 15 times 106, and that would be 1590. We add the two together and that comes to $2,500. We have bought 25 units. 25 units, $2,500. That's on average $100 a unit. So we're going to record them at $100 a unit. So the 20 units are sold at an average cost then of $100 $100 a unit. This leaves 5 remaining in this stock, and they would be recorded as having an average cost of $100 a unit. The third method that's used for accounting for inventory in terms of cost is something called the specific identification method. Now, the specific identification method is only used when we can directly identify the item that we're selling. And what we mean by directly identifying it, it has a specific purchase and a specific invoice, something attached to it that we can say, okay, this item has been sold. Now, that works good for larger items that would have a unique identifier, such as an automobile, a tractor, a piece of equipment, some form of art, or some custom furniture. These things that are big, expensive items, okay? So let's take a look at a simple example again. Well, again, we're going back to our inventory, but assuming here that this inventory is identifiable items. And again, we're starting out in August. We have 10 units that cost us $91 each for a total of $910. So there's our opening inventory of $910. We move along and we say, okay, that's great. We got that. We're going to buy now 15 more items, and we're going to identify each one of them. They'll all have their own invoices. So again, they're $106 each for a total of $1,590 in cost. And this results really in 2 layers of merchandise inventory. Now, they're all individually allocated. We can see each one has its own price. Someone comes in and buys them. And let's assume that in this particular case, when they buy them on August 14th, there's 20 items being sold, but let's say that 8 identifiable items came from the opening merchandise inventory, and that the remaining 12 of the 20 came from the August 3rd purchase. Now keep in mind that the original ones were the less expensive ones. They cost us $91, and the ones that were bought on August 3rd cost us $106. So here we're identifying which ones went out the door, okay? We can physically see which ones went out the door. So with that then, what we're going to have is 2 units remaining from the original merchandise and 3 units from the August 3rd purchase. So we could value those items accordingly. So 2 at 91, 3 at 106. So this would give us a direct measure of how much our inventory is worth at that point. The natural question that you would have is, which method should I use, or which method is better? Well, there's no better method, and it really depends on which type of business and what you're selling in order to be able to decide which inventory method is best. But once you pick one, you stick with it. So let's take a basic comparison then of the methods. And because prices are changing, really, you can see it here. So we have just a summary example of a particular business that sells product, and at the end of their period, they measure their cost of goods sold, their ending inventory, and the goods available for sale. And you can see, depending on the type of method that you use, you could theoretically have, if prices change, that's what would happen, different values. So cost of goods sold, for example, under FIFO method, here with 35.33, under the weighted average, it would be a little bit higher, and under the specific identification, it could be a little bit higher. So I guess in summary, what you need to do is look at, well, what are the relative advantages of each one? Well, if we look at FIFO first in, first out, it's the most current value on the balance sheet as ending inventory. That's important because, again, relevancy kicks in. It matches the flow of goods from many businesses that attempt to sell older inventory first, such as a grocery retailer. Obviously, you want to sell your older stuff first. The major disadvantages, though, is the cost of goods sold doesn't necessarily reflect the current costs, and so does not accurately match expenses to revenue. That's a little bit of a disadvantage. In terms of the moving weighted average method, the key advantage is it smooths out purchase price changes, keeps it consistent, and it matches the flow of goods for business that have a large volume of small items that don't expire, such as a landscape center selling stones and gravel. So if you don't have an inventory that would depreciate or something lose value over time, that would be helpful. And the major disadvantages, though, is that averaging doesn't accurately match the expenses and revenue. That's a fact there. In terms of the specific identification method, it exactly matches costs and revenues. That's its biggest advantage. It works well for companies that sell differentiated products with higher dollar value, such as a jewelry store, as I say, automobile dealership, or a equipment dealership. But it's relatively more costly to implement and maintain because you're going to keep track of every individual item. So for the purposes of reporting, then a company is required to use the same accounting methods for period to period. And that gives consistency, and that follows the consistency principle. A change is only acceptable when it improves the financial reporting method. You need to be able to prove to the authorities, Revenue Canada, for example, that this is going to be helpful, and the costing method used must be disclosed in the notes to the financial statements in order to ensure that readers have a clear knowledge of the method that's used. As we noted earlier, in order to be transparent and clear in our accounting statements, merchandise inventory must be reported at what it can be sold for. So really, this is known as the net realizable value, or NRV. So when the net realizable value is lower than the cost of the product, the inventory needs to be devalued. It has to be reflected in the books as being less valuable. If, for example, you are a fashion retailer and you haven't sold all the fashions, by definition, it's no longer fashionable, and as a result, the value of it is going to drop. So you need to be able to reflect that in your financial statements, and that's known as the principle of faithful representation. So generally, lower of cost net realizable value can be really applied in two ways. First of all, separate for each item, which works really good if you can individually value each item, or to look at groups of similar or related items and be able to reduce the value of them. Let's look at an example of the lower of cost net realizable value calculation. And really, when it's calculated, we can look at it from an individual, group, or a group level. So let's look at it from this individual level first of items and what items we have. Here we have an example of a sports store. The sports store has two groups of items, bicycles and kayaks. Now, of the bicycles, there's the roadster bike and the sprint bike. We ordered them in. We have 25 and 60 of the respective types of bikes. And we see that the total cost of the roadster was $18,750 and the total cost of the sprint was $66,000. We think the roadster bike has been very popular, and we think that really, we'll be able to sell those at a higher amount. We think that we could get good money for them. So we're saying, the net realizable value for them is actually higher than what we paid for them. Now, according to our accounting rules, however, we have to record them at the lower of the cost or the net realizable value. So the lower of the two are the purchase price, which is $18,750. So that's what it gets recorded at. That's the item recording. The sprint bike, we bought them for $66,000. The net realizable value is $66,000, so they're going to get recorded on an item basis at $66,000. Now let's just stick with the items first. Let's go down to the kayaks. We got the A1 series kayak. We ordered some in. We got 21 of them, $1,800 each. $37,800 was the total cost. However, people didn't really like those type of kayaks. They haven't been selling well. We figure the net realizable value for them will be $27,300. So that's a loss for us. Most we can sell them for is $1,300 a kayak. We're going to have to put them on sale in order to get rid of them. So we need to record it at $27,300, which is the lower of the cost and the net realizable value. The Trax, however, the Trax 4 kayak has done really well. It's $2,200, and we figure that that's what it costs to buy it. But we feel that we could get more than that. We figured that it's valued really at higher than that. The market has really liked them, so we think that the total group of them is worth $65,250. But again, accounting rules say we got to record it at the lower of cost and net realizable value. So the cost is $63,800. That's lower. We record it as that. So the item total then will be $175,850. So we could do it by individual item. It depends on the store. This store, if those are a few things we have, it's easy to do the item list. However, if we have thousands of items, it might be a little harder to do. So we need to group our items. So we could group bicycles and group kayaks, for example. So what we need to be able to look at is the total cost of the group So in the case of bicycles, it was $84,750 was the cost of the group. We figured the net realizable value is actually $85,750. We need to record it at the lower of the two, so $84,750. In the case of the kayaks, the cost was $101,600 for the group, and we figured that net realizable value is only $92,550. So really, we need to record it at $92,550. So essentially, what we're doing is being conservative on how much we feel that the product is actually worth in either case, be it an item basis or group basis. So accurate accounting of our inventory is important, because if we don't do it correctly, or if we don't value it conservatively, this is going to lead some misstatements on both our income statement and our balance sheet. Cost of goods sold will be off, gross profit will be off, profit will be off, current assets will be off, and equity will be off.